Okay. Hello everyone. Hopefully you can see and hear me good. Thank you for attending the second of the series of our free webinars organized by Mazars Quant teams from all over Europe. This last week, Pierre-Alexandre, Eric, and Corentin presented the EU climate-related guidelines for banks and brought the audience through topics related to integration of physical and transitional risk into bank risk framework. Today, together with Alex and Michal, we are going to talk about IFRS 9 and some benchmarking exercise we did on capital and liquidity requirements. And on Thursday, David and Xavier from our teams in Luxembourg and UK are going to discuss the IRBB topics and CSRBB topics. So we invite you to sign in on the third webinar if you haven't done so already. And of course, you can forward the invitations to your colleagues, so that might be interesting in the topic, because I know the credit risk and IRBB are not that aligned in terms of the people who are dealing with it on the bank side. So today in the first part, we're going to discuss about IFRS 9 modeling techniques which are used in the banks, and that concerns the ECL model as a whole and also the parameters. And in the second part, we're going to present some comparative analysis of the capital and liquidity measurements performed for a group of 121 banks that we did within Forvis Mazars. But before we start today's webinar, I would like just to shortly introduce ourselves. So I will introduce myself and then pass on to Alex and Michal to introduce themselves. My name is Szymon Turkowski. I'm a partner in the Polish office. I'm responsible for advisory services to the financial sectors, and I established here a Quant team which manages one of the topics it manages is IFRS 9. And I joined Mazars 3 years ago. That's when the team started here. We are now currently like competency hub for the CE region. And before joining Mazars, I was working for 11 years in big four companies, and before that I had some time also at the supervision authority offices. So I have a quite broad perspective and over 16 years total experience in the matter of IFRS 9 and regulations concerning banks and financial sector entities. And I will just pass maybe voice to Michal to introduce himself, so I don't have to introduce him myself.
Thank you, Szymon. So I'm Michal Cotelnic. I'm a senior credit risk manager for Mazars Quantitative Solutions in Ireland. I'm originally from Poland and have around 14 years experience in the credit risk management, IRB and IFRS 9 model development, model reviews, stress testing and risk reporting. And it's combined across Polish and Irish banks, and work with Forvis Mazars here in Ireland for almost 3 years. I'll let Alex introduce himself, and then we'll move to core part of our presentation.
So good morning, everyone. Thank you all for having me here today. My name is Aleksander Gorczański, and I am credit risk manager on the risk and quant advisory team in Forvis Mazars in Poland. I have been working in Mazars for a bit over 1 year, but I have in total 9 years of experience in credit risk. Previously, I worked in Big Four company. From the very beginning of my career, I was involved in IFRS 9 related projects, starting from standard implementation, followed by other redevelopments, reviews, validations. I also had an opportunity to perform stress test exercises, develop scoring models, or work on CRR related topics.
Okay, and maybe before we just jump to the core part of the presentation, a final organization note from my side. We planned this webinar for 1 hour, and we will try to talk for about 40-45 minutes. So then we can then take 15 to 20 minutes to take your questions, and we encourage you to ask those questions in the chat, so we can look at them, and we will do our best to answer as many of those as possible. If we will not be able to answer those now, you can write us, and we can contact and discuss it after the webinar. And both the recording of this webinar and the slide deck will be available, and we will provide you the link to this contact so you can review it after the webinar. And please, because we will be showing in the core part of the presentation, we will be showing results from the research we did on a very heterogeneous group of banks. So basically, we have there a couple of tier 1 banks, but also a couple of smaller ones. So please be advised that this results, if you do not recognize your bank within it in the terms that you are doing something different, please note that we had a very differentiated group of banks. So the results may vary, but you will see as we will present the core part of the presentation. So now I will pass the voice to Michal, who will start the discussion of IFRS 9 related topics.
So the agenda for this presentation is to start with a discussion about SICR criteria, so significant increase in credit risk. Then we'll discuss some results of our analysis regarding portfolio composition observed in banks, ECL coverage ratios, post-model adjustments, and their contribution to final ECL. We'll discuss, and then we'll move to techniques used in PD and LGD modeling, the ways of including forward-looking component to those risk parameters. We'll discuss macroeconomic scenarios and their usage in ECL models, number of scenarios used by institutions and their characteristics, and we'll touch also the approach to ECL formula used by different institutions. After discussing IFRS 9 related topics, we'll move to capital and liquidity requirements. So this will be shorter part of our presentation where we'll show the results of our benchmarking study performed in spring of this year based on Q3, Q4 data from more than 120 European institutions. This exercise was performed to somehow mirror the exercise performed by the BCBS, but on a slightly different sample of banks, and we focused on country level statistics rather than regional statistics based on Europe versus Americas versus the rest of the world. Moving on to SICR criteria. Sorry, maybe just a summary of IFRS 9 presentation. So we analyzed data and information from around 24 banks across 4 EU countries and the UK. Data was collected in April-May 2024, and we used data available as at Q3 or Q4 2023. And the main objective of our analysis was to find common things in approaches used by banks, and also differences in the ways the IFRS 9 was implemented in the banks. So probably the main focus would be approach to SICR and PD and LGD techniques used across institutions. Going forward, we analyzed the following metrics. Qualitative and quantitative reasons used to classify exposures to stage 1, stage 2, and stage 3. Modeling approaches, forward-looking information, and MEVs used in PD and LGD models, approach to ECL formula. We analyze portfolio quality, stage distribution, ECL coverage ratios and overlays, and scenarios, as I already mentioned. So this is the list of metrics we looked after. And the results, so starting from SICR, for stage 1, the main observation is that the general rule used by the banks is to classify all assets that are not classified to stage 2 and stage 3 as stage 1 assets. However, some institutions add explicitly or define explicitly that all investment grade financial instruments are assigned to stage 1. And it's worth noting that expert judgment is quite often mentioned by banks, that it's applied while deciding about classification to stage 1, 2, and 3. And it doesn't really matter how big the institution is, whether this is tier 1 or tier 2 or even smaller bank, that some level or extent of expert judgment is often used by them. For the quantitative criteria, so for stage 2 criteria, we split them into quantitative criteria and qualitative criteria. And we focused mainly on, more on quantitative side. A lot of those IFRS 9 related topics are covered in our semi-annual report that is available on Forvis Mazars websites across various European countries. So if you are more interested in qualitative side, and also probably more, if you're interested more into portfolio quality and types of overlays applied, and also about macroeconomic scenarios used, you can find all this information, as I said, on a semi-annual basis in that ECL benchmarking study report. We included link to it in our presentation. Moving to quantitative criteria, we see that some institutions use level of or number of grade or PD rating the notches as a threshold to move instruments from stage 1 to stage 2, and those thresholds may depend on maturity of exposure or initial or final or sometimes called lending rating. What we observed is that 30 days past due threshold is applied by vast majority of institutions. With regards to absolute SICR and relative SICR criteria, we saw in the benchmarking study that sometimes the absolute level of reporting PD, for example, above 10% or 20%, is used directly to classify exposures to stage 1 or stage 2, to stage 2, or to classify, to determine increase in credit risk. However, it's much more common to assess increase in PD since origination, or compare reporting PD as of reporting date with PD from origination date. And here we came across very wide range of thresholds used to determine significant increase in credit risk. For example, from 100 to 250 bips for corporate exposures, 75 to 350 basis points for retail exposures, 50 bips for mortgage loans, but we came across different thresholds for this type of portfolio, and again various thresholds for SMEs and for retail loans. And one of the observations is that a majority of banks are using different thresholds for different loan types, rarely having only one threshold defined for all portfolios in their on their balance sheet. For relative SICR, here we saw again very broad range of thresholds or changes in the level of SICR from origination to determine increase in credit risk. We saw everything from 1.3 to 25 times increase, depending on institution, on portfolio type, and in some cases on current PD or on definition of low risk exemption. However, the most commonly used level of threshold would be doubling in PD since origination. It's worth mentioning that sometimes those, as I said, like the relative threshold depends on low risk exemption, which is again set on different levels in different institutions and for different types of assets. We saw levels set at 0.2%, 0.3%, 0.5%, or 0.6% in our analysis. Probably it's not the full list that we came across. These are just examples. One interesting case is that some institutions do not use or do not refer to PD, increase in PD while defining SICR for their exposures. So we saw that for secured portfolios, it's sometimes the LGD or maybe more LGD side of the modeling, but in this case LTV is used to define significant increase in credit risk, while change or negative change in the ratio between the debt and discounted value of collateral. So finally, negative change in LTV is used to define SICR. This approach seems to be non-compliant with the regulatory guidelines. However, we noted that it was used in few cases for specific portfolios of secured assets. Moving on to qualitative criteria, we put them together in this slide. So the most common reasons used by banks to determine stage 2 classification would be forbearance, entry to watch list, definition as troubled debt or restructuring, risk rate being outside of normal risk appetite, manual downgrade or classification as stage 2 by credit analyst, negative change in economic conditions or like environment surrounding the exposure or the client in terms of regulatory, economic, technological changes, deterioration of internal or external rating given to the exposure. Less common triggers that we observed in our study would be change in entity's credit management approach to the instrument when the exposure was reclassified to from normal to more closely monitored exposure, however, without being put on watch list. Or other trigger would be would be increased sensitivity to macroeconomic changes in negative macroeconomic environment. One of the insights or observations from the analysis is that contagion effect, called sometimes pooling effect, sometimes causes classification to stage 2, sometimes to stage 3 for other items or for other exposures of debtor who is already reclassified to stage 3. So sometimes, even though some exposures of defaulted or stage 3 client are already in stage 3, the other ones would be only moved to stage 2 as a result of pooling effect. With regards to stage 3, generally its definition is aligned with the IFRS 9 objective evidence of impairment. And most common triggers that we observed in the study would be default status, credit impaired flag, and 90 days past due. Interestingly, one institution applies 120 days past due instead of 90 days past due, and it's not related to the payment frequency used by that institution. The other common triggers used for stage 3 would be non-accrual status, bankruptcy, repossession, liquidation, and deterioration of customers' financial situation, resulting in the inability to service current debt. Other triggers less commonly used, they were used by between 1 and, let's say, 5 institutions that we analyzed. It would be negative equity, EBITDA, sale with significant loss, debt, fraud. So many reasons are listed here in the slide, but they varied between institutions. Interestingly, majority of institutions in our sample apply materiality thresholds while defining stage 3 classification or exposures. However, those materiality thresholds are not always compliant with EBA guidelines or with prescribed levels of those materiality thresholds. So we came across different levels, sometimes compliant, sometimes not, and sometimes even like not rounded values, like 80 euro for retail exposures or 475 euro for corporate exposures. So it's sometimes difficult to understand what would be the reason of those differences or lack of compliance with the EBA guidelines. Moving on to portfolio quality analysis. We analyzed distribution of exposures to stages across all banks in the study. There is a caveat for first table that there was one outlier in the sample with significant share of the book in stage 2. So it was excluded from those summaries presented in the table. However, what we saw is that on average, almost 90% of exposures are classified to stage 1, more than 7% to stage 2, and more than 3% to stage 3. However, for stage 2 and stage 3, we saw broad ranges or really big variability between institutions, as you can see, ranging from 0.04% to 16% in stage 2, and from 0 to almost 12% for stage 3 accounts. For the ECL coverage ratio, we observed circa 10-fold increase in the ECL coverage ratio between stages. So around 0.5% for stage 1 accounts, 4.5% for stage 2, and more than 45% for stage 3, which is probably intuitive and expected increase in risk observed while moving to higher risk stages. Again, we observed very broad range of those coverage ratios used by institutions in the sample, as you can see, from 0.03 to 10% and from 5% to 65% in stages 2 and 3 respectively. Finally, we looked into share of post-model adjustments in total ECL, and the observation is that again they they vary very significantly between institutions from 0 to 59% in our sample. It's not related to location or main place of activity of financial institution. It's we can say quite random where those higher levels or lower levels of post-model adjustments are observed, and the average share of overlays amounted to 13% in our study. As I mentioned before, some of those topics are covered and definitely described more in details in that IFRS 9 benchmarking study report with final version released in July or August this year, which was based on half-year results of 24 or 26 EU banks. Now I'll give the floor to Alex to discuss PD/LGD modeling techniques.
Thank you, Michal. So let me talk a bit about how benchmarked banks dealt with the challenge of lifetime models development. This first slide presents how banks approach the topic of lifetime PD modelings, but to give you some context, one of the main challenges introduced by IFRS 9 is that they were obliged to calculate parameters in their lifetime horizon. So often this horizon was longer than the length of the available data series. For example, for mortgages, the maturity can be more than 20 or 30 years. So this is not the length that is available in banks. So the banks had to invent some methodologies how to extrapolate these estimates. And there is a lot of text on this slide, but I want to draw your attention to the graph on the left-hand side. And on this graph, you can see how many banks among this out of our benchmarking sample used given approaches. So the most predominant approach are migration matrices. Over 50% of banks have used this approach. It is based on Markov chains theorem and is based also on historical data where the institutions, they calculate the average probabilities of transition between ratings and between given rating and default. And by raising this average matrix to given power, they extrapolate it to the given horizon. The second approach, curve fitting to extrapolate conditional PDs, is something that is very well known in Poland, as this was the method preferred by banks, by majority of banks in Poland, short after IFRS 9 implementation, after the standard entered into force. But after that, however, we've experienced a shift in the trend. So a few banks, they replaced this method by migration matrices, and this is consistent with what we see across the European countries. Some banks, they can not have enough data to calculate their own models, so they are basing on some external sources. Either these are external data to calculate their models or external benchmarks. This is particularly the case for the banks which are new on the market, so they don't have available data to calculate the model, or they have very low, high quality portfolios, which means that very little number of defaults have happened in past. So it's not possible to calculate it on the default inside the institutions. We have also identified 3 other methods. One bank used group risk parameters, one bank used average conditional historical default rates, and one bank used hazard function. So the next slide is very similar to the previous one. And its aim is to present you with the approaches to LGD modeling. So similarly to PD, we have one predominant method, which is using average cure rates and recovery rates, which are dependent on the time in default. It means that, again, banks are using historical data. They are calculating average probability of average cure rate and average recovery rate for given time in default. It can be month in default, it can be quarter in default, and then they are the approaches can slightly differ between those banks, but basically they are using those curves dependent on the time on default in order to calculate the LGDs. So in the course of time, measuring from the beginning, measuring from the entering into default, the LGD is increasing, yes, as cure rates and recovery rates are decreasing. 4 banks from our benchmarking sample, they used external models and benchmarks. 3 of them are common, as it was on the PD slide. There is one bank which has its own PD model but uses benchmarks in order to calculate LGDs. And the third approach, I find it very interesting, as it shows how European countries and credit markets differ between each other, because in contrary to these models dependent on time in default, 2 banks built the model which is non-dependent on time in default. So this is the case when the NPL portfolio consists of mostly very old exposures for which the time in default is not longer a differentiating criterion. So the criterion which impacts the LGD more is NPL sale price, which is dependent on the market conditions. So and this is the crucial factor determining the loss in this case. 3 banks used other methods, which is again taking the parameters from the group. 1 bank used chain ladder method and 1 used binomial trees. Okay, and previous slides concerned the approaches to the so-called TTC, so through the cycle parameters calculation. Now we are moving forward to 3 slides, which will show how benchmark banks incorporate the macroeconomic forecasts in their estimates. So including so-called forward-looking factor in ECL estimates was one of the biggest challenges introduced by IFRS 9. Its goal is to include our forecast regarding the future market state, market conditions. So in case when the bank expect the crisis on markets by the forward-looking factor, it is allowed, and even not allowed, but even obliged to increase the parameters, so the ECL is increased. And on the other hand, if the bank expects the prosperity on the market, the parameters may be decreased, decreasing also the provisions. And on this slide, on the left-hand side, you can see the table which shows how benchmarked banks, what macroeconomic variables they used. So basically, what we can see that most commonly used variable is GDP. It is used by 21 banks, and given that 2 banks they do not include the forward-looking at all, it means that only 1 bank among those which include forward-looking factor does not use GDP. Second most commonly used variable is unemployment rate. Also, most of banks used it. Next variables are inflation, interest rate, where around half of banks utilize those characteristics, and other variables are less common. Real estate indices, in 4 cases, consumption stock indices, and number of other variables used by 1 or 2 banks. Moving forward to the methods used by banks to incorporate the forward-looking component in parameters estimates, we can see on the left-hand side the chart summarizing the approaches adopted by banks in terms both of both PDs and LGDs. And we can see that in both cases, in case of both parameters, linear regression is the most common approach. How banks incorporate the forward-looking component. So again, the approach may slightly differ between banks because there are details like including the autoregressive term or the logit function, inclusion of logit function, but the main approach is linear regression, which is the most common. What is worth adding that is quite common not to include the forward-looking factor at all, especially in case of LGDs. This may result from the different view on the topic from local authorities, where in some countries the banks are obliged to include forward-looking in all parameters, while in some countries it is possible to include it in only one, and in most cases this is PD. That's why a few banks, they do not apply forward-looking component in LGD. Another common method is to use single factor approach, known also as Vasicek model. These of you who are working on IRB models in regard to RWA probably know this model as it is part of the IRB RWA formula. The main advantage, I think, in case of forward-looking of this method is that banks do not actually have to build their own models. They just need to make some assumption on which factor they will use. The most common is GDP, and then they are calculating the correlation between the default rate and the systematic factor. So to know with what strength this factor impacts the estimates. There are also few banks using external models. 2 banks they are including forward-looking itself in LGDs. These are the same banks that I was describing on the previous slide, for whom the LGDs are not non-dependent of default, because they are dependent mostly on the NPL sale price, and this is inclusion of forward-looking itself. Last slide regarding the forward-looking factor is to introduce you what scenarios do benchmarked banks applied. So we can see on the left-hand side that in all cases the baseline scenario is the most has the biggest weight. Here we have included only 16 banks because these are those banks that have constant weights. Other banks, in case of other banks, the weights can differ based on other criteria. Yeah. So what is also worth saying is that the average weight of the downside scenario is higher than the average weight of the upside scenario, which means that on average banks are expecting market crisis, or let's say worse market conditions. And there are a few banks also which include fourth severe, like extreme scenario. It's like a stressed scenario, assuming very bad market conditions. But this was included only by 5 banks from our sample and with low weights. Moving to the right, we can see the share of banks with given number of scenarios. We can see that having 3 scenarios is the most common approach. However, 22% of banks, they are using 4 or even more scenarios. We have found 1 bank which uses even 6 scenarios. And moving right, we can see the share of banks with we can see the share of banks with given approach to weighting. So 73% of banks, they used constant weights. So these are banks presented on the left-hand side, and other banks, for them, the weights can be country dependent. They can use some more sophisticated approaches, or they just simply do not include forward-looking, so they do not have scenarios. Okay, and in regard to the ECL formula, on the next slide, out of our benchmark sample, we have identified only 1 bank which calculates the ECL explicitly as stated in standard in IFRS 9. So as you can see in the bottom on the slide, there is 1 paragraph from IFRS 9 saying that the cash shortfall is the difference between the cash flows that are due to an entity in accordance with the contract and the cash flows that the entity expects to receive. So this second term is already including the credit risk. So by subtracting those 2 terms, you obtain the expected credit losses. And there is only 1 bank which follows explicitly this formula. So for all exposures, they are calculating contractual cash flows, then expected cash flows with inclusion of credit risk, and they are discounting into the present value. This approach is a bit more complex than this, which has been applied by all other banks. So 23 banks, and they used the very common formula of multiplication of PD, LGD, and EAD. Of course, in 1-year horizon for stage 1 and lifetime horizon in stage 2, of course, including the discounting. Some banks, they also account for prepayment rates in their ECL models. Some of them, they are calculating ECLs in shorter periods of time and then aggregating it to annual figure. And some of them, they also include the survival rate component in the ECL formula. And I think this is all that we have regarding the IFRS 9. So I will pass the voice to
okay, thanks Alex. These are valuable insights indeed. Let me just say that there is a fine European Banking Authority report from last year concerning the approaches that the banks used for the IFRS 9 implementation, but it's just like kind of a surface report. You can read a lot of interesting things there, but not the ones we presented here regarding how the banks are modeling particular parameters. So really good analysis here. And now I would just like to pass voice to Michal to present the second part of our seminar and concerning the capital adequacy and liquidity requirements.
Thank you. So as I mentioned at the beginning of this webinar, we have analyzed Pillar 3 data for 121 banks. from 16 countries, and data was collected in April 2024 from the most recent Pillar 3 disclosures or year-end financial statements. So if data from Q4 was available, then we used them. If not, then we used most recent data at that point, so from Q3 2023. The sample included banks from the EBA supervisory list, and for comparison purposes, we also added the 7 largest UK banks and the 5 largest Polish banks. And this study was aligned with the BCBS March 2024 report, which covered 177 banks globally and used Q2 data. So our report had more recent data, and as I said before, it was performed on a country specific level to show differences between countries. What was the scope of our analysis? So we discussed those metrics or key figures. The main metrics that we analyzed was CET1 ratio, Tier 1 capital ratio, liquidity coverage ratio, overall capital requirement, total capital ratio, leverage ratio, net stable funding ratio, and buffer defined as overall capital buffer between requirements and capital available for the institution given in percentage points. And the summary of our outputs or of our analysis is presented in the table. We won't go into details for each country or for each statistic. We'll just give you some summary of the main insights. However, this presentation will be available after this webinar, so you can look into your country or market that you are interested in to look into those statistics. One of the outcomes from the analysis is that the capital adequacy ratios in our analysis are generally consistent with the BCBS study, with CET1 ratio in our study standing at 17.2%, while in the BCBS study it was lower, 13% for Group 1 banks, so Tier 1 banks, but it was very similar at 17% for Group 2 banks, so smaller banks. And for the liquidity ratios, we observed that the average leverage ratio in our study was at 6.7%, LCR at 204%, and NSFR at 134%, with which all 3 values were slightly above figures obtained in the BCBS study. However, again, these were quite similar values, however, always on a bit more positive or higher values observed in our study. And the difference might be driven by the fact that BCBS study used bigger sample, and it contained also institutions from outside of Europe. Going forward, the main outcomes or summary of outputs of our analysis. One thing to add about liquidity ratios is that we haven't observed any threshold breaches in our analysis, while in the BCBS report they mentioned that 3 banks reported a liquidity coverage ratio standing below 100%. However, it hasn't been specified whether it was observed for European bank, Americas, or rest of the world. So we cannot draw conclusions about comparison or make comparisons between our study and their study. In this slide, you can see volumes of institutions per country included in our study. So it's quite well represented across multiple EU plus UK countries. In this slide, you can see the mean total capital ratio, overall capital requirement, and overall capital buffer per country, with average levels for each ratio observed in our sample. Some insights from the analysis is that Belgium and Sweden have the highest total capital ratio, while Spain has the lowest one. Regarding capital buffers, Belgian and Swedish banks exhibit the highest buffers, while Greek and Spanish and Portuguese institutions exhibit the lowest buffers, which generally range from 4.25% to 10.58%. Here we present mean Tier 1 capital ratio observed in the sample per country and mean CET1 ratio per country. And here again, Belgium has the highest mean Tier 1 capital ratio and mean CET1 ratio, while Spain has the lowest ratios for both metrics. Regarding liquidity measures, in this slide we present liquidity coverage ratio and net stable funding ratios for all countries. As mentioned before, we didn't observe any breaches of those ratios at institution level, and also the average levels per country are easily above the prescribed regulatory thresholds. We don't show leverage ratio in this slide. However, we also haven't seen any threshold breaches for that ratio. One interesting observation is that the level of buffer is significantly higher for short-term funding. So LCR level observed in the sample is 204%, highly above the prescribed level, while NSFR is also above those regulatory thresholds. However, not that much above those thresholds as short-term ratio. So we can see that long-term funding is probably more difficult to obtain, to secure, and that's why NSFR doesn't show that high buffer in comparison to LCR. No breaches of those factors, as already mentioned. So this would conclude that short summary of capital adequacy and liquidity ratios analysis that we performed. From this analysis, we also put together a report which is available on Forvis Mazars websites across European offices, and it was shared also 1-2 months ago on LinkedIn. So there you can find more insights from that analysis and some distributions per country and country level information presented, let's say, per institution.
Okay, thank you, Michal. This concludes the content of our presentation. So we can take the last 5 minutes to answer some of your questions. So maybe I will start with this one because I find it quite interesting. Is the case whether within the IFRS 9 models the forward-looking information should be applied on each parameter level or on the ECL level? So we see this issue regarding a difference from country to country. Basically, the IFRS 9 standard requires the ECL values to be adjusted to include the forward-looking information. And as the standard loan does not make any remarks concerning each parameters, actually the parameters are not really described in the standards itself, then basically what we see is that some of the most commonly the companies and the banks use the forward-looking information in the PD values. But of course, with such application, you have a ECL in default, which is actually not including those informations because they are only contained within the PD parameter. But in other countries, and for example, Poland is one of those countries, the regulator requires every bank to consider the inclusion of the forward-looking information into each of the parameters, and that's what banks are trying to do with more or less success, especially in LGD, in the area of not the cure rates but the recovery rates. It's very hard to establish any dependencies, and these dependencies are not stable over time. And generally speaking, from our expertise and doing projects of IFRS 9 implementation across all Europe, we can see it's less difficult to model and establish those relationships in the forward-looking information within the developed countries, when we have like a stable economy over a couple of years, and then there is easy way to find the dependencies. In the developing countries and the Eastern Europe, it's more difficult, and more effort should be put in determining the dependency formula and the dependency pattern from the macroeconomic variables and the credit risk parameters. So this is basically, so it varies, but generally some of the countries have requirements to include it in each, or consider it in each of the parameters. So having that said, I see that we have two minutes only left. You have our contacts here presented on the slide. Of course, the presentation will be shared together with the recording of this webinar after the webinar to all the participants and all the people who signed up. So hopefully we can get in contact and help you with some answers that maybe that you may for questions that you may have. And I would like to thank very much Alex and Michal for preparing this presentation, and everyone joining this webinar just to see the interesting facts that we shared today. And of course, you can catch us on LinkedIn, you can catch us on email, and you can even call directly if you wish, and we will try to help you in any way we can in terms of those topics we have discussed, and many others, of course, as we are very, I would say, our scope of services is quite broad. So thank you very much again for joining, and please join also on Thursday's seminar concerning IRBB and CSRBB together with our friends from the UK and Luxembourg. So thank you very much, and goodbye.
Thank you.